also welcome on board Rashesh Shah and understand what he's making of the market construct right now. Rashesh, good morning. Good to have you on the show. Just wanted to understand how is it that you're scaling things right now? Because while we've had pretty much a one-way move up for the markets, off late, of course, they got a little bit wobbly when there were concerns around what's going to happen to heightened inflation, what the Fed move is going to be. And now you've got this Ukraine-Russia tension, which is pretty much blowing up markets across the world.
Yeah, I think if you go back and see the history, I think geopolitical events have always had a knee-jerk reaction from investors, and there is a global risk off that happens immediately, and gold goes up, and U.S. currency strengthens, and that's part and parcel of what I would call almost formula now. So there is a formulaic reaction that happened in the last couple of days, and I think we should just be okay with that. Most of the geopolitical events have actually not created a major long-term disruption in the market, whether you go back to the Gulf War or the Iraq War and all that. So I think partly we should take that in our stride that, the news that, Ukraine's news yesterday was a shock to the system and there was a knee-jerk reaction and a little bit of panic. I think on the India front, this doesn't change actually largely anything for India, where India is far away, we are in between, we are neutral, so we are not caught in this any crossfire. The one indirect effect of this on India could be oil price, but usually this can't last forever. So the moment this cools off in a day or two or a week or two, I think oil prices will come back, and somewhere around 80 to 100 oil price is what most investors are now factoring in for India. Anything more than that will always be a concern. So I think the only thing to worry about is, will this lead to a long-term rise in oil price, which could hurt India via inflation? Outside of that, I think the India story, the corporate earnings coming back, strong bank balance sheets and corporate balance sheets, capex coming back via government capex now and then corporate capex, all those are still intact. So I don't think this changes medium to long term India story. Short term, we have to worry about geopolitical knee-jerk reaction as well as keep an eye on oil price.
Rashesh, for the retail investor out there who's clearly in panic mode, and yesterday was a grim day when everyone was a little worried on whether or not to throw in the towel into the fire or not. What's the message to retail investors out there? Because you clearly can't be, catching a falling knife. You can't be buying the market the way it was yesterday or has been off late, or for that matter, start even drawing up your list just yet, because if you were to take the valuation comparable, Indian markets in any case have fallen a lot less than our US counterparts, and valuations are still looking pretty rich as per the historical averages.
Yeah, but the valuations also factoring in the growth revival of India. Last 8 years, corporate earnings have been growing very slowly. So the current valuation is not just a static point of view. I think people expect India to be one of the few growing large economies in the world. I think corporate earnings, which has been growing at single digit for last 8 years, should start coming back in the next 4 or 5 years. I think everybody expects at least a double digit corporate earnings growth going forward. So I think when you look at valuation, it's a mishmash of a lot of things: liquidity, earnings, growth, all of that put together. But I think I'm very happy you used the phrase retail investor, because I think one thing about being an investor, and I think it's been true for the last 20, 30, maybe 100 years also, is you should never panic and you should never become euphoric. So I think when you said if retail investors are panicked, then maybe they are not investors, they are traders. And I think retail trading is a very high intensity job. Very few people really make the cut. But I think if you are a trader, you might swing from one end to the other. But as an investor, if you are a retail investor, I think you need to keep in mind that this is India's long-term story. What are the drivers of that? And also keep your cool. Don't get panicky, because panic anyway is going to cost you. Now, maybe the market will continue to fall. Maybe there'll be volatility. But for a long-term investor, the volatility should be your friend and not your enemy. While for a trader, the volatility can be your enemy if you are not really on the cutting edge. So I would say retail investors should remind themselves that they are retail investors first and all. And unfortunately, you can't take a 3 month view as an investor. You have to take a 3 year view. Like we in business, we tell ourselves we can't even take a 3 year view. We have to take a 15 to 20 year view on businesses. So if you want to be an entrepreneur, you have to take 15, 20 years. You want to be investor, you have to take 3 to 5 years. If you're a trader, you can take a short term view. But I don't think this kind of environment is very trading friendly.
Yeah, sure, it's not because the kind of volatility and one way move up, one day move down that you're seeing is definitely playing with fire for traders at least. But Rashesh, just to the point that you were earlier making, that the critical pivot point here is how crude pans out from here and the kind of inflationary bearing that it's going to have on the Indian economy and India Inc.'s earnings. In the interim, say for the next 6 months, for investors out there, should they be a little bit wary of inflation sensitive stocks at least?
I would think so. I think there are two issues around inflation. Inflation per se has, I think, been largely factored in. The RBI reaction to inflation, RBI has been very sanguine. And RBI has said that inflation has peaked out in Jan and they expect this, the current inflation to also start cooling off and will remain in the RBI comfort zone of 4 to 6%. If it goes consistently stays about 6 for the next 3 months, then it starts becoming a concern. But then the concern is not inflation, the concern is RBI tightening liquidity, interest rates going up. So I would say, yeah, I think a 50 to 100 basis point rise in interest rates over the next 1 year is already factored in by the markets. Anything more than that will be a shock to the investors. So given that, I think whatever, as you said, inflation sensitive or interest rate sensitive companies are there, I think some amount of this has been built in because global liquidity, RBI eventually raising rates after 4 to 6 months is all in the expectation. But as long as that quantum is between 25 to 50 basis points in this year and maybe overall 100 basis point over the cycle, I think that will not create a major disruption for companies and for investors. Anything more than that is a concern. But as I said, I think the oil price rise is very clearly linked to the geopolitical event, and geopolitical events have a tendency to cool off after a week, after 2 weeks. They don't go on for 3 years or one year also nowadays. So I think on that basis, I would say, I think oil price, if it comes below 100, around 80, 85, it's in comfort zone for India. And I think then India's other elements of the India story continues to play out.
Rashesh, hi there. Good morning. Avan joining in as well. But if we look at the kind of trade setup that we've seen, one thing that stands out is that the FIIs, they've been rather relentless in their selling. What would you attribute this to if given the fact that we're talking about our economic factors being rather intact, only crude being the big volatile factor, the markets as well having factored in a lot of these geopolitical risks? What would you attribute that to?
I think FIs are usually medium to long-term player, and one of the things has been that last 5, 6 years they have not seen corporate earnings growth in India. So I think their selling is not only now. I think the last 3 years there has been a lot of selling. Last whole year there was a lot of FI selling. This 2 months, Jan and Feb for this year, has been surprisingly high amount of FI selling, and it's everybody. I think everybody is shocked at the quantum of FI selling, but also pleasantly surprised at how easily it's got absorbed. So I think FIs have sold almost 50, 60,000 in this year. They sold almost the same amount in the last whole year. So if you look at the last 2 years, they've sold more than $20 billion of Indian equities, and which is not a small amount. In the past, it would have created a lot of panic and chaos in India. But I think it's also the third factor which is playing out is the Indian investors, the local, as you know, India's savings are almost close to $1 trillion. The gross domestic savings are close to $1 trillion. And if in that context, about 20 billion of FI selling has got absorbed, it's good news for India because at least in capital, especially risk capital, because equity markets are always about risk capital. I think in risk capital, I do think we have become Atmanirbhar now. There are a lot of areas where government wants India to become Atmanirbhar, but we were always like, even today, we still import oil and we do import some of the other things. But at least on capital, on risk capital, India has now truly become Atmanirbhar. And I think that's a good news. The last 18 months, $20 billion equity selling of FIs have got absorbed without a panic and with very calmly. In the short term, it always creates a liquidity overhang and pressure in the market. And FIs are selling for two reasons. I think last 8 years, not much corporate earnings growth rate that has come in India. And B, obviously, global liquidity cycle is reversing. So some of the hot money or some of the money that gets reallocated very quickly is starting to go out of India. But I think the fact that it got absorbed is, to me, the best news out of this.
All right, India has become Atmanirbhar in terms of risk capital. Rashesh, we leave it on that note. Appreciate your time and thanks very much for sharing your views.